Are you making costly investing mistakes right now without even realizing it? The truth is, even experienced investors fall into these traps, and it could be quietly draining your wealth. Imagine working hard to grow your money, only to discover you've been unknowingly losing hundreds, or even thousands, because of simple investing mistakes. In today's video, we're breaking down the top 9 investing mistakes that could be costing you money right now, and how to fix them. Some of these errors are based on common myths, while others are simple steps that many investors forget to take. Either way, avoiding these mistakes can supercharge your path to financial success. We'll cover key points like misunderstanding risk. Are you playing it too safe or taking on too much risk? Ignoring fees, hidden costs that quietly drain your profits. Emotional investing. Making decisions based on fear or excitement can lead to big losses. And that's just the beginning. By learning these tips, you'll make better choices, grow your investments faster, and avoid losing money along the way. So, if you're serious about improving your financial literacy and boosting your investment returns, stick around. These tips could save you thousands and help you reach your financial goals faster than you thought possible. Welcome to Profit Province, where financial education is our gift to you. Although these tips seem simple, they can make a big impact if you use them. Stay until the end for the best tip that I wish I knew starting out. Number 9. Neglecting continuous learning. One of the biggest mistakes investors make is believing they know enough once they've learned the basics. This mindset can quietly hold you back from achieving long-term success. The truth is, investing isn't something you can master once and forget about. Financial markets are constantly changing, and new opportunities, as well as new risks, can appear when you least expect them. Think of investing like learning a new sport. Imagine picking up basketball, learning to dribble and shoot, and then stopping your training. You might feel confident in your skills at first, but as the game becomes faster, more complex, and new techniques emerge, your old habits won't be enough to keep you competitive. Investing works the same way. If you stop learning, you fall behind. Financial regulations can change, new investment strategies may become popular, and emerging industries can offer exciting opportunities. Without staying informed, you risk missing out on key trends that could boost your returns, or worse, falling victim to avoidable mistakes. For example, imagine investing in a company without realizing new government regulations are about to impact that industry. If you had kept up with financial news or continued to educate yourself, you might have known to adjust your investments before losing money. On the flip side, those who stay informed often spot trends early and make smarter moves as a result. The good news is that staying educated doesn't have to be overwhelming. You can read books, follow trusted financial websites, or watch YouTube channels like this one to keep your knowledge sharp. By committing to continuous learning, you empower yourself to make better investment decisions and avoid costly errors that uninformed investors may fall into. In a world where financial success is tied to knowledge, investing in your education may be one of the smartest investments you'll ever make. Start small. Commit to reading one financial news article each morning or watching one investment-focused video per week. Over time, these small habits can compound just like your investments, helping you stay informed and make smarter financial choices. Number 8. Neglecting to rebalance your portfolio. Imagine carefully building a strong investment plan, one that perfectly matches your risk tolerance and financial goals. At first, everything seems to be on track, but over time, things start to shift, sometimes without you even noticing. That's what happens when you forget to rebalance your portfolio, a mistake that can quietly weaken your investment strategy. Rebalancing your portfolio is like tuning a musical instrument. Over time, as the market changes, your investments can drift away from your original plan. For example, if stocks perform really well, they may grow to make up a larger portion of your portfolio than you originally intended. While that might seem like a good thing, it actually increases your risk. If those stocks suddenly drop in value, your entire portfolio could take a significant hit. On the other hand, if safer investments like bonds have grown too large in your portfolio, you may be missing out on better growth opportunities. Without rebalancing, your investments can become unbalanced, leaving you more vulnerable to market swings or limiting your potential gains. The key is to review your portfolio regularly, at least once or twice a year, to ensure your investments match your financial goals. By selling assets that have grown too large and reinvesting in those that are underperforming, you restore balance. This keeps your risk level in check and allows you to take advantage of new market opportunities. The good news? Rebalancing doesn't have to be complicated. Many investment platforms offer automatic rebalancing tools that adjust your portfolio for you. Whether you choose to manage it manually or automate the process, staying on top of your portfolio's balance is a smart way to protect your investments and stay on the path to financial success. Take 5 minutes today to review your portfolio's balance. Even small adjustments can make a big difference in protecting your wealth and maximizing your returns. Number 7, letting emotions drive decisions. Imagine spending months carefully building your investment plan, researching strategies, choosing stocks, and planning for long-term growth. Now picture the market suddenly dropping. Your heart races and panic sets in. You feel the urge to sell everything before things get worse. This emotional reaction is one of the most common and costly mistakes investors make. Emotional investing happens when fear or greed takes control of your decisions. Fear often drives people to sell during market downturns, locking in losses that could have been recovered if they had stayed patient. On the other hand, greed can push investors to chase after hot stocks or trends that seem too good to pass up. While these moves may feel right in the moment, they often lead to poor results and increased risk. For example, during a market crash, some investors panic and sell their stocks at low prices. Later, when the market recovers, they miss out on the gains. Conversely, when a stock is rapidly rising, greed can push people to invest heavily without proper research, often buying in too late when prices are at their peak. The best way to avoid this mistake is to build a disciplined investment strategy and stick to it. Create a clear plan based on your financial goals, risk tolerance, and timeline. Then, when emotions start to take over, remind yourself of that plan. Instead of reacting impulsively, review the facts, analyze the situation, and make informed decisions. Another helpful strategy is automating parts of your investing. Tools like automatic contributions and rebalancing features can keep your investments on track without the risk of emotional interference. Next time you feel nervous or excited about a big market change, pause before acting. Take a deep breath, revisit your investment plan, and make decisions based on logic, not emotion. Staying calm and disciplined can help you stay on the path to long-term financial success. Number 6, trying to time the market. Many investors dream of buying stocks at their lowest point and selling them at their highest. It sounds simple: buy low, sell high. But in reality, trying to predict the market's ups and downs is extremely difficult, even for experienced professionals. This mistake ranks at number 6 because it leads many investors to gamble on market movements instead of sticking to proven strategies. Market timing often feels tempting because the idea of making quick profits is exciting. However, this approach rarely works consistently. Imagine you hear the market is about to drop, so you decide to sell your investments to avoid losses. But instead of falling, the market rises, and now you're stuck watching your missed opportunity slip away. On the flip side, you may hear that stocks are set to skyrocket, so you jump in, only to see prices tumble shortly after. These types of timing mistakes can hurt your returns and cause unnecessary stress. The truth is, no one can predict market movements with certainty. Even professional investors with years of experience often struggle to time the market successfully. That's why a smarter strategy is to focus on long-term investing and consistent contributions. One of the best ways to avoid market timing mistakes is to use dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, no matter what's happening in the market. By doing this, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this approach can reduce your risk and improve your returns without the stress of guessing when to invest. Instead of worrying about market timing, commit to investing consistently. Whether the market is up or down, sticking to a steady plan can help you build long-term wealth and achieve your financial goals with less anxiety. Number 5, failing to diversify. Imagine putting all your money into one basket, a single stock, company, or industry, and expecting it to carry your financial future. While this may seem like a confident move, It's actually one of the riskiest mistakes an investor can make. Failing to diversify ranks at number 5 because it exposes you to unnecessary risk and can severely hurt your portfolio if that one investment performs poorly. Diversification is like building a sports team. You wouldn't fill a basketball team with only point guards. You'd need players who excel at different roles. Investing works the same way. By spreading your money across different types of investments, such as stocks, bonds, real estate, and international markets, you reduce the impact of a single bad investment dragging down your entire portfolio. For example, imagine you invest heavily in technology stocks because they've been performing well. If the tech sector suddenly faces a downturn, your portfolio could take a major hit. However, if you had also invested in healthcare, energy, or consumer goods, those other investments could help balance out the losses, giving you better overall stability. A well-diversified portfolio should include different asset classes, like stocks and bonds, industries, such as technology, healthcare, and finance, and even regions, investing both locally and internationally. This strategy spreads your risk and increases the chances that some of your investments will perform well, even if others struggle. The best part? Diversifying doesn't have to be complicated. Exchange-traded funds, ETFs, and index funds are great tools for gaining broad exposure to multiple industries and markets with just a few investments. Take a moment today to review your portfolio. Are you relying too heavily on one industry or company? Adding a few diversified investments could strengthen your financial future and help you achieve more consistent growth. Number 4. Overreacting to market volatility. Imagine waking up one morning, checking your investments, and seeing the stock market has dropped sharply. Your heart races, and you feel the urge to sell everything before prices fall even lower. Or maybe the opposite happens. The market surges, and you feel pressured to jump in before you miss out. These emotional reactions are common, but they often lead to costly mistakes. Overreacting to market volatility ranks at number 4 because it highlights how emotional decisions can hurt your long-term success. When prices swing dramatically, it's easy to let fear or excitement take over. But reacting impulsively often means locking in losses during downturns or overpaying for investments during rallies. For example, imagine you panic sell your stocks when prices fall. Later, when the market recovers, you've already missed out on the gains. On the flip side, if you rush to buy stocks during a surge, you might invest right before prices drop again. These reactions are common, but they often do more harm than good. The truth is, market volatility is normal. Prices naturally rise and fall over time. Successful investors understand this and stay focused on their long-term goals. Instead of reacting emotionally, they trust their investment strategy and avoid chasing short-term trends. One smart way to stay calm during market swings is to build a well-diversified portfolio. Diversification helps reduce the impact of volatility by spreading your investments across different assets. Another strategy is to focus on consistent contributions through dollar-cost averaging, which helps smooth out the effects of market fluctuations over time. The next time the market takes a dive or surges unexpectedly, resist the urge to make quick decisions. Instead, revisit your investment plan, stay calm, and remember that patience often leads to better long-term results. Number 3, ignoring fees and expenses. When people think about investing, they often focus on how much money they can make. But one of the biggest mistakes investors make, and one that can quietly drain your wealth, is ignoring fees and expenses. This mistake ranks at number 3 because even small fees can have a huge impact over time. Imagine you're filling a bucket with water. If that bucket has a small leak, you might not notice at first. But over time, that leak can waste a surprising amount of water. Investing works the same way. Fees may seem minor, but they can quietly eat away at your returns year after year. Common investment fees include management fees, trading commissions, and fund expenses. Actively managed funds, for example, often come with higher fees because managers are constantly buying and selling stocks. Frequent trading can also add up quickly, with each transaction chipping away at your profits. The difference might seem small, perhaps 1% or 2% in fees, but over decades, this can translate to thousands of dollars in lost growth. For example, imagine you invest $10,000 with a 7% annual return. With a 1% fee, your balance could grow to around $76,000 in 30 years. But with no fee, that same investment could reach nearly $100,000. That's a huge difference, and all because of fees. The good news is that you can avoid this mistake by choosing low-cost investment options like index funds and exchange-traded funds, ETFs. These options often have much lower fees than actively managed funds, allowing more of your money to grow over time. Take a moment to review your investment accounts. Check for hidden fees or excessive expenses, and consider switching to low-cost alternatives if possible. Keeping more of your money invested means greater potential for long-term growth and financial success. Number 2, chasing past performance. Imagine hearing about a stock that skyrocketed in value last year. The company made huge gains, and now everyone's talking about it. You might feel tempted to jump in, hoping the stock will keep climbing. But here's the problem. Just because something performed well in the past doesn't mean it will keep succeeding in the future. This mistake ranks at number 2 because it's a trap that catches many investors. People often assume that if a stock or fund has recently done well, it's sure to keep going up. Unfortunately, this mindset can lead to buying investments at their peak, just before they start to drop. This mistake often results in buying high and selling low, which is the opposite of a smart investment strategy. Markets are constantly changing, and what worked yesterday may not work tomorrow. For example, a company that thrived during a tech boom might struggle if the industry cools off. Or a fund that soared during a bull market may underperform when conditions shift. Instead of chasing past winners, focus on the fundamentals. Things like a company's financial health, leadership team, and long-term growth potential. Diversifying your investments and thinking long-term can help you avoid risky decisions based on past performance alone. A helpful strategy is to create an investment plan that focuses on your personal financial goals rather than chasing trends. Sticking to a well-thought-out strategy will help you stay disciplined and avoid falling for flashy success stories that may not last. Before investing in a stock or fund that's recently surged, take a step back. Ask yourself if the investment fits your long-term goals and if it's backed by solid fundamentals. Staying focused on smart strategies instead of chasing past performance can lead to more stable, lasting financial growth. You made it this far in the video, you must really want to improve your chances and investment. If you have not already, consider subscribing to the channel. More videos just like this can be found on this channel. Number 1, not having a clear investment plan. Imagine setting out on a road trip without a map or GPS. You might know your destination, but without clear directions, you could end up lost, frustrated, or wasting time and money. Investing without a plan works the same way, and it's the most common mistake that holds people back from reaching their financial goals. This mistake ranks at number 1 because a clear investment plan is the foundation of successful investing. Without it, investors often make decisions based on emotions, follow trends blindly, or take on risks they aren't prepared for. A strong plan acts as your financial roadmap, keeping you focused and guiding you through market ups and downs. A good investment plan should outline 3 key things. 1. Your goals. Are you investing for retirement, a home, or your child's education? 1. Knowing your goals will help you choose the right investments. 2. Your risk tolerance. How much risk can you comfortably handle without panicking when the market dips? 2. Understanding this helps you balance safer investments with higher growth opportunities. 3. Your time horizon. Are you investing for the next 5 years or the next 30? 3. Longer time frames may allow you to take on more risk, while shorter time frames often require a more cautious approach. Without this structure, it's easy to make impulsive decisions, like selling during a market dip out of fear or chasing the latest investing trend. But with a clear plan in place, you can confidently stay on track, knowing that your choices are aligned with your long-term goals. If you haven't already, take some time to write down your investment goals, risk tolerance, and timeline. Creating a simple, clear plan can dramatically improve your chances of building wealth and achieving lasting financial success. If you like this video, then check out this next one on frugal living. You will come closer to your financial goals if you can pull this one off.